Gold didn't move because traders drew a prettier line on a chart. It moved because buyers demanded real metal, and the system that's supposed to absorb that demand started showing strain fast. 47, and then it snapped lower to roughly $5,164 in the same breath of market time. That kind of move isn't normal. That kind of move is a message. Let that sink in. A market doesn't climb into uncharted territory and then drop more than 4% unless something behind the scenes is shifting. Sometimes that something is leverage being forced out. Sometimes it's a liquidity vacuum. And sometimes it's a demand shock colliding with supply that can't respond on command. The next 72 hours matter because this is the window where the market shows its true character. Strong trends don't need constant headlines, and they build higher lows. Weak blow-offs don't stabilize, they unravel. So here's the core question. Ask it plainly. What happens when gold demand outstrips the amount of deliverable supply willing to show up at today's price in a market that's priced in paper but anchored in physical reality? Because this isn't just about a number on a screen. This is about plumbing. It's about settlement. It's about whether the price is still a smooth negotiation or whether it's becoming a forced auction. Start with the structure. Gold trades in multiple worlds at once. There's the spot market where transactions settle quickly. There's the futures market, especially COMEX, where standardized contracts trade almost around the clock, often used for hedging and speculation, with delivery rules that most participants never actually touch. There's the London wholesale market, commonly tied to the LBMA ecosystem, where large, good delivery bars sit in professional vaults and move via ledger transfer more than forklift. And there are major physical centers in Asia that can pull metal when local demand surges. Most of the time, these worlds stay connected. Arbitrage keeps the price aligned. Physical can be tight in one place and loose in another, but the system usually adapts. The stress begins when too many buyers want the same thing at the same time. Immediate exposure, physical certainty, and minimal counterparty risk. And they want it now, not later. That's when phrases like outstrip supply stop being a macro headline and start becoming micro symptoms. Premiums widen, delivery preferences rise, spreads become jumpy. Now take a look at what the demand data has been saying. According to the World Gold Council's full year demand reporting for 2025, total gold demand reached about 5,002 tons, an all-time high, with investment demand surging to roughly 2,175 tons. And in value terms, that demand was estimated around $555 billion for the year. That's not a retail curiosity, that's a global capital decision. At the same time, central bank buying was still large, even if it slowed, cited around 863 tons for 2025, in major coverage of the World Gold Council's figures. Meanwhile, gold-backed ETF holdings expanded dramatically, with reporting indicating an increase on the order of 801 tons and a fourth quarter surge that dwarfed the year before. In plain language, investors didn't just show up, they stampeded into the same doorway. And here's the part that should make attention lock in. Supply doesn't respond to that kind of surge the way people assume. Gold supply is inelastic in the short term. Mine output doesn't suddenly jump because the price went vertical this week. New projects take years. Even recycling, the sell old jewelry flow, takes time, and it often lags because people don't rush to sell when uncertainty rises. Higher prices can increase recycling eventually, but eventually is not the next 72 hours. So when demand accelerates quickly, the market has to do something else. It has to pull from inventories. It has to pull from the float of metal that's actually for sale. It has to shift metal between regions. It has to offer a higher price to pry bars loose from strong hands. That's where the London data becomes crucial. 261 trillion, roughly 728,512 gold bars by their estimate. That's enormous. And it also proves an important point. Existence is not availability. A vault number is a stock. A market is a flow. A lot of that vaulted gold is held as reserves, allocated to owners, pledged as collateral, or simply not for sale at today's price because the holder values insurance more than yield. In a fear-driven bid, some owners become less willing to sell, not more willing, which can make the available float feel tight even when the total stock is huge. So when someone says gold is out of supply, the accurate translation is usually this: deliverable supply at the margin is thin relative to the size and speed of incoming demand. And when the buffer is thin, price can get violent. That violence just showed up. Gold ran toward $5,600, then dumped toward $5,164 in a sharp reversal, and the rest of the commodity complex shook with it. 66 a barrel in the same session, tied to geopolitical fears, while risk appetite was whipping around the globe. This is the kind of environment where gold behaves less like a sleepy hedge and more like a global referendum on trust. Now connect the macro dots. There are only a handful of reasons gold erupts like this. 1, currency confidence gets shaky, not necessarily collapse. just enough uncertainty that the store of value bid strengthens. 2, geopolitical risk rises. The world doesn't need full-scale war to reprice safety. It just needs credible uncertainty. 3, real yields and policy expectations shift. When markets believe purchasing power risk is rising faster than policy can contain, gold becomes the insurance trade again. 4, financial conditions tighten in weird ways. Liquidity can be plentiful in one corner and scarce in another. When positioning is crowded, air pockets form. And 5, the market structure itself amplifies the move. Futures are leveraged, ETFs are flow-driven, dealers hedge. When a trend breaks out, momentum buying can accelerate. When it reverses, stops can cascade. That last point matters most in the next 72 hours. Because the move just experienced has all the fingerprints of stress, not just enthusiasm. Now shift to the mechanics most people skip. In futures, markets like COMEX, most contracts never deliver. They roll, they net out, they close. That's normal. The system works because most participants want price exposure, not pallets of metal. But the delivery mechanism matters because it anchors credibility. Even if a small percentage stands for delivery, the market needs to believe delivery is possible, orderly, and fairly priced. That's where terms like backwardation and contango come in. Contango means futures prices are higher than spot, typically reflecting storage, financing, and convenience. Backwardation is the opposite, spot tighter than futures, often a sign of immediate scarcity or stress in getting metal right now. Gold doesn't live in deep backwardation often, so when physical tightness increases, the market watches spreads, lease rates, and premiums for signs of strain. Those signals don't have to scream system failure to matter. They only need to whisper tightening while price is already vertical. That combination is how markets transition from trend to price discovery. And price discovery is a polite term for nobody knows where the clearing price is until enough sellers show up. So what does the chart say right now? First, acknowledge the obvious. Gold is extended. Published daily price history for January shows gold moving from the low to mid 4,300s at the start of the month to well above $5,300 later in the month. That's not a gentle uptrend. That's a sprint. In a sprint, the 20-day moving average lags far behind, roughly in the upper 4,000s to around 4,900 based on the month AS prints, which means price is stretched far above its recent average. That's the kind of condition where momentum indicators like RSI can push into extreme territory, often above 80, sometimes higher, a zone where markets frequently experience sharp pullbacks, even if the long-term trend remains bullish. Let me repeat that. An extreme RSI doesn't mean the bull market is dead. It means the market is tight, like a rubber band, and rubber bands don't relax gently. They snap, either sideways into a consolidation or downward into a shakeout. Now mark the levels that matter psychologically and structurally. The first is $5,000, not because it's magical, but because it's an anchor. It's a narrative line. It's where headlines change, where positioning changes, and where many late entrants mentally confirmed the move. The second is the pullback zone around the low $5,100 to mid $5,100, because the market already showed a reaction there after the drop toward roughly $5,164. The third is the record high band near $5,600, because that's where supply finally punched back, hard enough to halt the sprint. So the next 72 hours become a test. Does gold build a floor above $5,000, or does it slip back under and struggle to reclaim it? Does volatility compress or expand? Does the market print higher lows, or do rallies get sold aggressively? Those are the tells. Now, and this is critical, don't ignore the bearish case. A real bullish script includes the risks, because the risks shape the path. Here's the bearish case, stated cleanly. First, the move may have been driven by speculative excess. When price runs that far, that fast, leverage piles in, late buyers chase, trend systems add exposure, then a reversal triggers forced selling, and forced selling can overshoot. Second, margin and liquidity dynamics can change quickly. In high volatility, exchanges can raise margin requirements, liquidity providers can widen spreads, and risk systems can pull back. That can create a feedback loop. Volatility causes tighter liquidity, which causes more volatility. Third, positioning can be crowded across instruments, futures, options, ETFs, structured products. When too many investors share the same directional exposure, the market becomes fragile to any surprise. A stronger dollar, a sudden shift in rate expectations, a geopolitical headline cooling off, anything can trigger a flush. Fourth, the physical tightness narrative can be misunderstood. London Vault stocks are large. Gold exists. Tightness often shows up in the marginal deliverable for sale float, and it can ease if price rises enough to bring sellers out, or if demand pauses even briefly. And fifth, there's the simplest risk of all in gravity. Markets don't go vertical forever. They either consolidate or correct. The only question is how, and how violently. So yes, a deeper pullback is plausible. Even a sharp, ugly pullback is plausible. Now here's what those bearish points don't change. They don't change the demand trend. Global gold demand hitting about 5,002 tons in 2025, with investment demand above 2,100 tons, is not a fleeting impulse. And they don't change the role gold plays when the world is debating currency credibility and geopolitical risk at the same time. This is capital reallocating at scale. So the question becomes, what comes next? The next 72 hours can be broken into 3 plausible paths, and the market will reveal which one is dominant through behavior, not commentary. One path is consolidation. Price holds above $5,000, trades choppy, volatility starts to compress, and the market forms a base. This is how strong trends cool off. It looks boring compared to the rally, but it's constructive. Another path is a shakeout. Price drops hard, maybe tests the $5,000 line, maybe even dips under it briefly, triggers fear, flushes leverage, and then snaps back when real buyers step in. This is common in strong bull markets. It's also emotionally brutal. It convinces people it's over, right before it resumes. The third path is a failed bounce. Price drops, attempts to recover, but sellers keep leaning on every rally. Higher highs fail, momentum fades. The move starts looking like a blow-off rather than a base. If that happens, the market may need time to rebuild before the next major leg. So how to read it in real time without pretending to predict it? Watch 3 signals. First, respect for $5,000, not as a prophecy, as a psychological truth serum. If price holds above and builds higher lows, demand is defending. If price falls below and can't reclaim, the blow-off thesis grows teeth. Second, volatility character. A healthy consolidation shows ranges narrowing. An unhealthy unwind shows wide, chaotic swings that keep expanding. The move from near $5,600 to near 5,164 already shows elevated volatility. The next question is whether that volatility calms or keeps screaming. Third, confirmation from physical and flow data. Premiums, reported ETF flows, and the tone of wholesale market tightness matter. When investment demand is driving, the chart can stay disconnected from common sense longer than expected. Because the buyer isn't looking for a bargain, the buyer is looking for exposure in insurance. Now consider the historical rhyme, not as a guarantee, as a pattern. In 1979 to 1980, gold entered a phase where uncertainty and inflation psychology pushed price into a parabolic blow-off. And then policy expectations and positioning created a violent reversal. In March 2020, markets showed a different kind of stress, dislocations, logistics bottlenecks, and spreads that reflected physical constraints, even while paper prices whipped around. Today's environment is not identical, but the rhyme is this. In stressed regimes, gold doesn't move like a slow hedge. It moves like a referendum, and referendums swing. Now zoom out to the human side of the market, because that's where supply and demand really live. When gold makes new highs, 2 different buyers appear. One is the momentum buyer, chasing the move, often using leverage or short-term vehicles. That buyer is fast and emotional. The other is the strategic buyer, buying because something is changing in the worldview. Currency risk, sovereign risk, portfolio insurance, diversification. That buyer is slower, but deeper. If the market is only momentum-driven, it collapses when momentum breaks. If the market is strategically driven, pullbacks get bought. Not immediately, not perfectly, but consistently. That's what the next 72 hours will reveal. Now translate this into implications for different audiences, without confusing education with instruction. For traders, the priority is survival. A market that can drop hundreds of dollars in a session can wipe out poor risk management quickly. Extreme momentum conditions can persist, and reversals can be sudden. Entries matter less than position size and exit discipline in this environment. The goal is not to be right, it's to avoid being forced out. For long-term investors, the priority is process. If gold is being repriced as insurance, chasing the top and panicking on pullbacks are the 2 classic mistakes. This is the time to focus on time horizon, exposure sizing, and the reason gold is in the portfolio at all, hedge, diversification, or speculation, because those are not the same. For physical holders, the priority is reality. Physical markets involve premiums, spreads, and availability. Even if the spot price pulls back, local conditions may remain tight depending on region and product. The key is understanding that physical and paper can behave differently in stressed moments. For new participants, the priority is clarity. Headlines make it feel like a one-way ride. Reality is a staircase, and stairs have landings, and sometimes they have broken steps. Now bring it home with actionable intelligence, the kind that fits the next 72 hours. Expect turbulence. Not because the trend is fake, but because the market just accelerated so rapidly that it has to digest. Watch $5,000. Watch whether the market defends the low $500. Watch whether volatility begins to calm. Watch whether price rebounds toward the mid 5,300s without immediately being slammed back down. And most importantly, watch behavior around the highs. If gold approaches the $5,600 area again and sells off violently, supply is still leaning. If it approaches and consolidates just under the highs, holding gains, the market is telling a different story. Now, verification matters. World Gold Council demand reports are public. LBMA vault data is published. Spot price history is widely available. These sources allow independent confirmation of the core facts. Demand in 2025 around 5,002 tons. Lendavault holdings around 9,106 tons at in December 2025. And a late January price spike near $5,600 followed by a sharp pullback toward the low $5,100. Don't let the narrative run faster than the data. And now the risk disclosure, stated plainly. This is educational commentary, not financial advice. Gold can be volatile, especially after extreme moves, and price can swing sharply in response to macro headlines, policy expectations, liquidity shifts, and positioning. There are no guarantees. Any market can reverse, any trend can overshoot. Position sizing and risk tolerance matter, and independent research matters. So, what comes next? When demand overwhelms supply at the margin, in a market built on leverage, confidence, and global flows, the next move is rarely subtle. Either the market proves strength by building a base above the breakout level, or it proves fragility by failing to hold it. The next 72 hours won't answer that with opinions. It will answer it with price behavior, volatility character, and whether buyers defend the levels that now matter. Watch the floor, $5,000. Watch the reaction zone, the low 5,100s. Watch the ceiling, near 5,600. Because when gold moves like this, the market isn't whispering anymore. It's speaking.